All right, so I have the camera zoomed in a little more so you can see in more detail. Chapter 5, we cover financial statements and closing the books. We're going to start with financial statements. So in Chapter 4, we learned that we needed to have an unadjusted trial balance and then adjust the entries and make an adjusted trial balance. So the adjusting entries were for the accrued expenses and accrued revenues. So we adjusted the trial balance, and we did find in Ann's company, Greater Athletic Performance, that her debits did equal her credits. So her debits equaled $39,250, and her credits equaled $39,250. So the basic accounting equation was in balance, and therefore we can move on to the income statement, or the financial statements, I'm sorry. And the first one that we're going to cover is the income statement. Then we're going to move to the owner's equity statement, then the balance sheet, and then the statement of cash flow. So the first one, no matter what, the first one you have to do is the income statement, all right? The income statement shows your revenues and your expenses, and it shows your net income or loss, depending on if you gained or if you lost, all right? So what I'm going to do is I'm going to take the information from the adjusted trial balance from Greater Athletic Performance and put it into the income statement. All right, so we have at top Ann's Greater Athletic Performance income statement for the month ended in March 31st of 2020. All right, so month ended March 31st of 2020. Now, the income statement covers a length of time. It's important to note that the income statement covers a length of time, because when we get to the balance sheet, that's just a snapshot of what the organization owns and owes, and what the owners have invested in the organization. So the income statement is for a length of time. So this is for the month ended March 31st, 2020. And it's going to show your revenues and your expenses. All right, so if we look back at the adjusted trial balance of Greater Athletic Performance, we see that Ann had revenue of $3,500, so $3,500 in service revenue. So we take that revenue and we put it to the income statement. So we have service revenue here, $3,500, and it's shifted to the right because it's a credit. Then we list our expenses. So we look back at the adjusted trial balance and we see our expenses. So we have advertising expense, we have rent expense, supplies expense, and wages expense. So we're going to list them in order based on how much they are. So the highest goes to the top, all right? So we have rent expense, which is $1,700, and that's the highest number, so we're going to list that at the top. Wages expense of $750, you see here, $750. We take that from there and put it into the income statement. Then we have our supplies expense of $315. And we have our advertising expense of $250. All right, so let's total those up. Let's total those up and see what we get for our net income. All right, net income. And it's going to be an income because it's not negative, all right? So if it was negative, it would be a net loss. So our net income is, we take the $3,500 and we subtract the expenses here, and we get a total of $485 for our net income, right? So our total is $485 for our net income. And again, we took the revenue and the expenses and we posted it to the income statement from the adjusted trial balance. All right, so we took that information, we put it to the income statement. And again, the income statement is for a period of time, all right? So it's not a snapshot. The balance sheet, when we get to it, you'll see that it's a snapshot of what the company owes, and what the owners have invested in the company. All right, so net income. Now you'll see how net income is a part of owner's equity. So we move from the income statement to the statement of owner's equity. So right here we have Ann's capital as of March 1st. Now Ann didn't have anything invested in the company as of March 1st. So this statement is for the month ended March 31st. All right, so at the time of the 31st, we find out that Ann invests $35,000 to open Greater Athletic Performance. So prior to that, she had nothing invested in the organization. So we see that she invested $35,000 in the organization. We see that under capital here from the adjusted trial balance. So we take the net income from the income statement, we put it under net income here, and then we take Ann's capital as an investment because she invested that $35,000 to open her organization, and we put that here, investment, $35,000. So we see that the total with the net income equals $35,485. Now, if Ann did have income invested prior to opening the organization, so if, say, the organization had been running for a long period of time, Ann had already invested money in the organization, that would show up under Ann's capital from March 1st. So it would show up as the capital from the previous period. All right? But since she didn't, this remains zero, and we see that we add net income and Ann's investment to get $35,485. All right, now we look at Ann's drawing. So we take less than Ann's drawing of $400. Remember, Ann withdrew money from the organization for her own personal use. She withdrew $400. So we take this total and we subtract the $400 from that total, and we get an increase in owner's equity of $85. So it increased by $85. So we have $35,085. All right, our increase is $35,085. So Ann invested $35,000, and now her owner's equity is at $35,085. So it's increasing by $85. So Ann's capital as of March 31st, again, is $35,085. So again, we take her investment from the adjusted trial balance under capital, $35,000, and put it here, and we take the net income from the income statement and put it here. Now you can see how the revenues and the expenses add up to the net income, and the net income is part of the owner's equity. All right, so then once that's calculated, this is just considered owner's equity. You don't have to consider it revenues or expenses, all right? So that's the owner's equity statement. All right, I'm going to erase this, and I'm just going to cover a few things, and then in the next video, we are going to cover the balance sheet and the statement of cash flow. All right, so the income statement. Remember, is revenues minus expenses equals net income or loss. All right? Revenues minus expenses equal net income or loss. Owner's equity, I'm going to abbreviate owner's equity as OE. So you see owner's equity is the previous capital. Let me erase that. Previous capital, and you saw that Ann didn't have any previous capital, so it just remains 0, plus net income, plus any investments, and minus drawing. Equals total owner's equity or capital. Alright, so those are the two statements we covered. We covered the income statement, which is revenues minus expenses equals net income or loss. And we covered owner's equity, which is the previous capital. If there's any previous capital, like I said, Ann didn't have any other money invested in the organization prior to investing the $35,000, so that was 0. But if she did, then you would put it there. You would add the net income to it, and any other investments, you would subtract the drawing, and then you would get the total owner's equity or capital. And again, the information is taken from the adjusted trial balance. Alright, the next step, so we started with the income statement, we took the information from the adjusted trial balance, then we did the income statement, got the net income from the income statement, then we put the net income into the statement of owner's equity. Our net income for Ann's greater athletic performance was $485, and we added that in, we subtracted what she withdrew from the organization, and we got a total increase in owner's equity of $35,085. So that's the owner's equity statement. From the owner's equity statement, we move to the balance sheet. See the balance sheet here? And the balance sheet really is a snapshot, a picture of the organization's assets, liabilities, and owner's equity. So what the organization owns, owes, and what the owners have invested into the organization. Alright, so we're going to take the information from the owner's equity statement and from the adjusted trial balance. Alright, so we're going to use both documents to complete the balance sheet for Ann's greater athletic performance. Alright, so let's start off with assets. So as of March 31st, what were the organization's assets? So first, let's start with cash. So we go over to the adjusted trial balance, and we see that our cash account was at $12,300. So we take that number and we put it into the balance sheet. Accounts receivable. What were our accounts receivable accounts at as of March 31st? They're at $2,350. So we take that information, we put it into the balance sheet. Supplies. We'll look over here, $185. And we put it over here. Furniture was $1,000 as of March 31st. We take that from the adjusted trial balance and put it there in the balance sheet. Equipment was $20,000. And we put it here. So we're going to total up our assets and our liabilities after we do our liabilities. So our accounts payable, if we look over here, our accounts payable was 0. Ann did not owe for accounts payable, but she did owe her employees wages that they were not paid for at this point in time. So she owed them $750. So we took that from wages payable here on the adjusted trial balance, so I abbreviated it WP. Accounts payable, I abbreviated AP, and accounts receivable, I abbreviated AR. So wages payable, $750. We put it over here in the balance sheet. Now our owner's equity. Now we need our owner's equity statement. All right, so let's move over here to our owner's equity statement. And we find that Ann's capital as of March 31st is $35,085. So it increased by $85. So we take this number and we put it here, $35,085. Now when we add them up together, we find that we have $35,000 $835. So $35,835 in total liabilities and total owner's equity. Our total assets, when we add all these up, the $12,350, the $185, the $1,000, and the $20,000, we get $35,835. All right, so our total assets, total assets equal our total liabilities plus our owner's equity. So our balance sheet is in balance. And again, this is a snapshot of what the organization owes, and what the owners have invested in the organization. All right, so that's a snapshot. The other ones are for a period of time. So the income statement and the statement of owner's equity are for a period of time. This is just a snapshot of what the organization owns, owes, and what the owners have lay claim to in the organization. All right, so just to go over the financial statements that we covered. Income statement. Income statement is your revenues minus your expenses equals net income or loss. Did your company profit or did they lose? All right, so revenues minus expenses equals net income or loss. NI I abbreviate for net income. You can see I abbreviated these statements. IS for income statement, OES for owner's equity statement, and BS for balance sheet. All right, revenues minus expenses equal net income or loss. Did the company profit or did they lose money? Owner's equity statement. You take the previous capital. Did the owners have capital that was already invested in the organization? Plus your net income, so you take it from the income statement and you put it on the owner's equity statement, net income. Plus any investments, minus any draw. Did the owners withdraw any money from the organization for their personal use? Minus draw equals the increase or decrease in owner's equity. Did it increase or did it decrease? All right, and that's your total capital. So the owners lay claim. That's the total amount that they can lay claim to in the organization. All right, so from the owner's equity statement, we move along to the balance sheet. Now you have to do them in this order. From the income statement to the owner's equity statement to the balance sheet. All right, and all the information we took from the adjusted trial balance, right? So the balance sheet is your assets, your liabilities, and your owner's equity. Does that look familiar? Yes, it's a basic accounting equation. Assets equal liabilities plus owner's equity. So the basic accounting equation, the balance sheet takes that equation and makes sure that the companies, what they own, what they owe, and what they lay claim to all equals out in the end, and the debits equal the credits, right? So our owner's from the owner's equity statement, we take the owner's equity, so we take that total and put it in the balance sheet. So you have to do them in the order that you're supposed to do them in. Starting with the income statement, going to the owner's equity statement, and then to the balance sheet. And we take the information from the adjusted trial balance as well. But when you put the owner's equity in here, you have to take the owner's equity from this statement, not from the adjusted trial balance. All right, so the owner's equity for the balance sheet has to be taken from the current owner's equity statement, not the capital from the adjusted trial balance. So these are the statements that we covered so far, and next we're going to be covering the statement of cash flow. But this is the order in which these three statements have to be done. All right? All right, the next financial statement we're going to cover is the statement of cash flow. Statement of cash flow. So the other three statements are all interrelated. So first you do the income statement, you take the information from the adjusted trial balance, you put the information that you need into the income statement, the revenues and expenses to get your net income. Then you go over to your owner's equity statement, and you take the net income and you include it on the owner's equity statement. Then you take that information and put it into the balance sheet. You have your assets, your liabilities, and your owner's equity that you took from the owner's equity statement. Well, the statement of cash flow is not interrelated like that. It only monitors cash activities. So it's only concerned with the cash account. And only when cash changes hands would it be recorded on the statement of cash flow. So if you purchase something on account, it's not going to be recorded on the statement of cash flow. The statement of cash flow is only concerned about when cash changes hands. When cash is moving in and out of the organization, that's what it's concerned about. So what you'll need to know for the statement of cash flow is only the different sections of the statement. All right, so there's three different sections. There's operating activities, investing activities, and financing activities. All right, you're going to need to know what falls under those activities. But you're not going to need to calculate it. You're just going to need to know those activities. All right, so we're going to discuss a little bit about the different activities of the cash flow statement. So operating activities. So anything that cash is used for operation, anytime a transaction happened, it would be recorded in the cash flow statement. So cash from customers, the cash coming from customers would be recorded on the statement. Cash paid for inventory. The company purchases more inventory. The cash paid for that inventory would be recorded on the cash flow statement. Cash paid for salary expenses. The employees are part of the operation, right? So under operating activities, cash paid for the salary would be under operating activities. Cash paid for general and administrative expenses. So any general and administrative expenses paid for would be recorded here. So anything paid for, supplies, anything general and administrative expenses, paper, pens, pencils, ink, anything under that would fall here under cash paid for general and administrative expense. All right, so then you would have the net cash flow from operating activities, and that would be listed here as a total. All right, then we move to investing activities. Cash for sale of equipment. All right, cash for sale of equipment. So cash paid, that's cash that would be received for selling equipment. So cash received for selling equipment. Here we have cash paid for building. So you purchase a building, that would be recorded under investing activities because a building is an investment. Cash paid for land. Again, land would be an investment. So the purchase of the land would be recorded under investing activities. Then you would have the net cash flow used by investing activities. But since you got cash for sale of equipment, that would be subtracted from the amount that was paid for the building and the land. But again, you won't have to calculate that. All right, then we move from investing activities to financing activities. All right, any financing activities would be cash received from a loan, cash received from withdrawals, cash received from stocks, something like that. So financing activities, borrowing from your 401k or something like that would be financing activities. So you have here cash paid for withdrawals. That's an example. So then you would come down here and you'd have net cash flow used by financing activities. So the total amount used by those financing activities. Then you would have your decrease in your cash balance here. So your decrease or your increase depending on what it was. Then you'd have your beginning balance. Fix that. Beginning cash balance. And you would subtract your decrease in your cash balance from your beginning cash balance to get your ending cash balance. And your ending cash balance based on these activities should equal what's in your cash account. Alright, so that should equal what is in your cash account. So what you need to know is what falls under operating activities, what falls under investing activities, and what falls under financing activities. So these are the activities or sections of the cash flow statement that you'll need to know.